Welcome to Simple Trading. My name is Jordan, and welcome to this channel where I make trading simple, whether simple or complex. And in this video, we're going to talk about understanding monetary policy. Guys, we're going to talk about what I believe most traders might not be talking about. Now, I had did this video previously um, in one of my Facebook groups, and it was very interesting because they started to censor me. I think I was giving away the secrets, guys. So I'm hoping that here on YouTube that this information is allowed. I'm going to choose my word in a certain way so that way this information uh, doesn't violate any guidelines. But however, I'm gonna just read between the lines because I'm about to give you the secret to understand a monetary policy, which is gonna help you how you see the market and how you trade. Now, if you're new to this, if you're new to forex, I want you to go back and watch my video on what is forex. And you don't know what exactly I'm talking about, but if you've kind of been diving in and you're starting to get the information and learn the skill and learn how the markets work, this is going to be very helpful to you, and especially understanding this from a fundamental perspective, meaning a understanding trading from a fundamental perspective when it comes like example reading the news, or when it comes to understanding how world events affect the market. So in this video, I'm not specifically exactly how can I say I'm not specifically talking straight to technical analysis, which is marking up the charts, but this will affect your technical analysis. Please understand that. What I'm about to show you will affect technical analysis. However, what I'm going to show you, though, is going to help you understand the market from a global sense, understand the market from a fundamental sense, understand the market from the sense of the entities that are moving it, from the powers that be that are moving the market and making decisions on the masses. Okay, so let's talk about this understanding money policy, how the central beep affect the market. As I said, guys, I'm gonna be censoring myself so that way, these secrets are not censored, not violate guidelines. How the central beep affect the market. Who are the key players in the financial world? Who are the key players? Who are the key players in the market? They are your beep. They are the central bees. They're the central bees, guys. That's simple. I know I didn't really get into the stuff yet. So they're probably saying, oh, Joe, you're not really giving me anything yet. But just hang on. Hang in. Hang in. These are the key players in the market, guys. Okay. Now, if you watch my first video on what is Forex, I briefly explained, okay, who are the people in the market? We have the banks, the institution, the corporations, and the retail traders, right? And the retail traders are me and you, right? They're the individuals, right? They may even be the small firms or the small companies that haven't really got to a financial institution level, but these are the retail traders, and the majority of the traders are going to be me and you behind, people that be an individual like me and you. Maybe some of us might work in Wall Street or work in Chicago on the exchange, or a lot of us might not have any type of financial career, but we're just people behind a computer, and we're learning the skill, and we're learning how to get in the market, and learning. We have our money in our bank account. We got our little Bitcoin, or we might have just downloaded our trading view, and open an account with our broker for the money that we worked from our 9 to 5, or maybe our side business. That's us, retail traders. And we're about 20 to 25% of who's in the market. Now, where's the other percentage, the 70 to 80%, right? The 75 to 80% of the market, they are the banks and institutions and the corporations, right? These are the people, these are the entities, I should say, that are in the market. Now, the central Bs, they are the ones who influence currency values, meaning they are the ones that are influencing the rates. They're the ones that are influencing how much the currency is and how much the currency moves, right? And not only do that, they institute price stability, meaning that they're going to be the reason why your dollar one day is not worth $1, then the next day that same dollar bill, let's say it's not worth, is worth $5 or is worth 50 cents, right? They're going to keep the value of the currency stable, so that way there isn't massive inflation or massive recession, right? They're going to be the ones that create economic growth, right? The central Bs, they're the ones that want to create growth for your economy, right? By the exchange and trading through the market and other policies that are set. And the central Bs also, the influence of how they affect currency is also going to influence on employment. They're going to be the ones, right? Because they're the ones that are creating the how much the market values that specific currency, right? Is that's going to determine employment, right? How much do people get paid, right? And also the way the market moves is going to determine, if there is money to be paid out, right? Or I should say how much, because money to be paid out, of course, is dependent on value that's given into the market by people's services and goods. Now, so again, they're moving the market. The Bs and the institutions move the market. Now let's get into this is just some of the stuff I really want to get into. Now, how the Bs said monetary policy determines the goals of price stability, economic growth, and employment. I know you're probably saying, Jordan, what do you mean by that? What are you talking about? What are you talking about? What does that mean? What are you talking about? Get your notepad and your paper out. Please, if you don't have one, get it out. Take notes, because I'm about to give you some serious sauce. If you learn how to use this, this is going to be a serious addition into your arsenal as a trader, and helping you get those big moves and helping you see what's happening in the world or in your economic demographic in your country, and seeing how that's going to really affect the market, right? So what I'm about to give you is this. So I know you're probably asking, what are you talking about? How the B said monetary policy determines the goals of price stability, economic growth, and employment. And what is that? It's really it's actually two simple words. Interest rates. Now, there's some other things we're going to get into, but this is the main thing. Interest rates. When it comes to fundamentals, what I've discovered from my research and from my analysis and my back testing and really sitting down and going back, I said, my goodness, interest rates. And what are interest rates? Interest rates are the amount lenders charge borrowers, with a percentage being the principal lending. So I want you to think about, if you were to go buy a car, right? Or if you were to go buy a house, what normally happens? You go and you might not have all the money. You go and buy that car, right? You say, hey, I'm going to go get this new car, 2000, whatever it is, for the year that you're watching this video. It cost me $50,000. Let's say 50,000 US dollars. I'm thinking it cost me 50,000 US dollars to get that. But you say I don't have 50,000 US dollars in my hand right now. I only have about 15. So I need the other. Was that 35,000? So how do you obtain that money? Through a loan, right? You get a loan, and what comes with that loan? Interest. So you have $15,000 cash. You say I can put a down payment on this, but it's going to cost me 35 grand. I need extra 35 grand to finish this payment. So what happens? You take out a loan with who? The bank or loan company. But who are they consulting with? Who are they getting money from? The bank. That $35,000 that you need to get from the bank, right? It has an interest rate, meaning that it's a loan. They're going to give you that money so you can finish that payment. So you can complete that $50,000 payment to get that car. But you need to pay back that $35,000. Are you hearing me? You need to pay back that $35,000. Because $15,000 you gave is yours. That was your money. $35,000 is not yours yet. It's being given to you. It's being borrowed to you until you pay it back. $15,000, you have an interest rate that's put on top of that. So that $15,000, they might say, okay, it's XY amount interest rate over the next 2 years that you have to pay that. And so let's say when you calculate the interest, $15,000, it might be equivalent to about, let's say, 20,000. So you pay back that 15 plus another 5,000, which is your interest. You pay back $5,000 of interest. So depending on what the rate was, will determine how much interest you pay, right? So if you have $15,000, let's say, you have that $35,000 that loan, right? And you have 10% interest, right? So you're gonna be paying 10% of interest on that $35,000, which is what, $3,500. So you got to pay back, let's say, $3,500. Some of those interests will be probably more now. Probably might be like 18.9%, or imagine you get 20% interest. So you're paying back, what's it, $7,000 interest. This is what interest is. So the rate that's set, it's that rate. What is the rate? The 10% or the 18% or the 7% or the 5% or whatever that percentage is, that is the rate. Check this out. So what does this have to do with monetary policy? What does this have to do with monetary policy? What does this have to do with monetary policy? Interest rates are the amount lenders charge borrowers. Remember what I just said? It's the amount that bank, that loan company charges you, with the percentage being the principal lended. Meaning that they charged you, they gave you the $35,000 for that car, but they charged you 20%, let's say, on that $35,000. Again, which is $7,000. So the rate was that 20%. What does this have to do with monetary policy? I want you to look at this graph that I created. This is an example of interest rates. I want you to look. I have a bar graph. It says currency, 15. It says more lending, 100%. Balance, 60%. What I want to show you is this. Is that when there is more lending in the market. Okay, so I'm going to do my best to try to break this down as simple as possible. Interest rates. How does this correlate to monetary policy? When the interest rate of a currency, the interest rates of an economy goes up, when they rise, if I'm in America, for example, and our interest rate goes up, guess what happens? It actually attracts more lenders. And normally these lenders are foreign. So this attracts lenders, foreign countries that come in and they say, ooh, they have a high interest rate. So let's come in and lend money. Why? Because our country's gonna have to pay us back. Excuse me. And when they pay us back, we're gonna make really good money because the interest rate is up. So meaning that if there's a higher interest rate, meaning that the capital, the principal, the amount of revenue that country or lender gives to that other country, they're gonna have to pay it back. And so that means there's gonna be more money to be paid back. So I hope you're following me in this. I'm gonna try to break this down one more time, make it simple. The higher the interest rate, foreign countries come in to lend their money. So if America brings the interest rate up, and a country like, I don't want to say, I got to be careful what I say because they might ban my channel, ban my this video, I should say. Let's say America goes up, or let's say a country like Taiwan. I'm gonna use a more insignificant, but I want to say a different country, but I'm not gonna say those names. But let's say a country like Taiwan comes in and they say, "Oh, America's interest rate goes up. We're gonna go and lend them some more money for their economy." And then America's gonna say, "Okay, thank you for this money that you've given us a boost, and we're gonna use it for X, Y, Z, and we're gonna pay you back." And so now when they pay back Taiwan, let's say, gave 100 billion. Now when America pays back Taiwan because it has such a high interest rate, now let's say they give Taiwan back 300 billion, right? Because it's like that car, right? So when you go buy the car, guess what? $50,000 you had to pay, but you got that loan, right? Because you got a $35,000 loan, but you wound up paying back the company. You paid them back, not $35,000. You paid them back. Let's say you paid them back $45,000. So that company made money, and higher the interest. Imagine this would be totally unacceptable and not realistic. But let's just say you bought a car for $50,000, and that interest rate was 100%. So imagine you borrowed $35,000 and you have to pay them back 100%. You could have to pay back $35,000 plus $35,000, which is what, $70,000. Imagine you have to pay back $70,000 because the interest rate is so high. Monetary policy. These companies come in, not company, I should say, the country raise the interest rate. Other foreign lenders come in. They say, "Oh, you have $100 billion," but that country needs to. They had a catastrophe. They need to build back up. Let's say from a catastrophe, or they have a economic recession, or maybe there's a war or something, and they need. I gotta watch my words. Or maybe there's something that they need to kind of bounce back, and they say, "Okay, we're gonna have 100 billion, but we need 500 billion to rebuild." And this other country comes in and says, "Okay, don't worry, we have the 500 billion uh, or the 400 billion that you need to complete that, but you're gonna have to pay us back at 500 billion. Let's say you're gonna have to pay us back, let's say, 10% interest, right? 500 billion, 10% interest would be what, 50 billion. So now they made back 550 billion. But imagine that interest rate is high. Imagine that interest rate is 50%. 500 billion. Now you got to pay us back 250 billion more. You see where I'm getting at? So the higher the interest, the more it attracts lenders to come in. So just like you bought that car, the higher interest is not good for you. It's not good for me. If I go buy that car and I got to pay a high interest rate, I'm the consumer. It's not good for me. But guess who it's good for? It is great for the lender. It is great for the lender. See, higher interest rates attract more lenders. I hope you guys get. If you're getting this, please put in the chat. I got it. Put in the chat. I got it. Put a 7 in the chat. If you're not getting this, let me know, because we're gonna. If I gotta do another video, break this down, we'll do it. But the higher interest rates attract more lenders. And parentheses I put in foreign because normally it's foreign, right? Because we're dealing with currencies. So we're dealing with currencies. We're dealing with countries. We're dealing with whole demographics. So when the currency and prices rise, demands for raises increase. Ooh. So if the dollar gets more powerful and prices begin to go up in the economy, right? Prices on food or whatever. Normal people say, okay, I need more money. I got to survive. Even though the dollar is getting better, but everything is still going up. And this causes the buying power of the currency of that economy to decrease, causing inflation. And so when high interest rates come, this is what happens. When high interest rates happen, more lenders come in, they give that money, but guess what? That country knows they have to pay back. So what's going to happen? Prices are going to go up because they got to recoup that money to make sure they pay it back. The value of the currency goes up, right? Because the lenders came in and they gave their value to add to that value. However, that economy, that country knows that currency. They know they have to raise. Not only that currency goes, they know they're gonna have to raise the prices on everything that currency purchases, right? Because they need to pay that money back. However, when that happens, the normal people like me and you see that and they say, "Well, we need more money then because everything is getting expensive. Bread is getting more, milk is getting more. I need more money so that I can pay my bills and I can feed my family." And what happens is that when the buying power of the currency of that economy, again, decreases, guess what? It causes inflation. Meaning that when they need more raises, and that means that when their raises go up and they don't have as much buying power, inflation comes. Great. But again, that's what? Good for the banks. Terrible for the consumer. And so how does this get resolved? It gets resolved by oh man, I gotta watch my words because they might ban my video. It gets resolved by an entity known as the FED. You see right there, the FED. And they use a process called this: quantitative easing. What is quantitative easing? What am I talking about? What does this have to do with monetary policy? Quantitative easing is what? It's a monetary policy where central banks like the U.S. FED Reserve purchase securities from the open market to reduce interest rates and increase the money supply. I know you're probably saying, what is he talking about? What is Jordan talking about? I'm not getting this. Monetary policy where central banks like the U.S. FED Reserve purchase securities from the open market to reduce interest rates and increase the money supply. Quantitative easing. It is a policy where the central banks like the U.S. FED Reserve, which is a private organization, people think is a government entity, and it's not. It's a private organization that has power in this world to print money. They purchase securities. They print money. That's basically what it's saying. Print money from the open market. Print money from a market that is just, they created this market from a market they created that has no restrictions, that has no limits, to do what? To reduce the rates and increase the money supply. Guess what? Some of you guys that are in economics might understand that. You've heard about this, you've researched about this, you've learned about this, that when they just begin to print money out of thin air, the value of the money or I should say, there's a scare for depression, right? There's a scare for a recession, right? Right? Quantitative easing. Guys, they banned my video the last time I did this. When I got into this, quantitative easing, it is the printing of money, guys. Guess what? More money though equals higher interest rates and less stability, which equals inflation. But guess what? When this happens, when this happens and they do this, you normally see a scare. You normally see a scare for the consumers saying, oh man, inflation's happening. Why? Because now milk costs more, bread costs more, it costs me more to live, right? Because they're starting to print more money, right? They're starting to print more money, right? The interest rates are up like crazy. There's less stability now because maybe not getting that raise. You don't know what's happening with the market. You don't know what's happening with the economy. And so inflation happens, right? Inflation happens. But guess what? I've seen this so many times. The inflation hurts you in your normal life. But guess what? That inflation and that high interest rate, it benefits the central B's, and it normally benefits the lenders and the big money holders and movers. Have you ever seen where you say, "Oh my God, it's about to be massive inflation," and I'm looking at the market, I'm analyzing the market, I'm looking at technical analysis, and guess what I see? I just see the market keep going up and 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 up, guys. This is direct bank intervention in the currency markets. I'm going to show you this practically. I want you to look at this. I want you to look over to the right column on the top. And if you look at the history, you'll see some percentages, right? You'll see some percentages. And if you look to the left, what this report is actually talking about, it is actually talking about the interest rate at which depository institutions and lend balances held at the FED reserve to other depository institutions overnight. Meaning that this is the, but this is saying that the money that's being held and printed is being lent out. The FED reserve is printing money. They're holding it in the little safe, and basically they're lending it to other institutions, right? So that way they can also borrow. And now the FED can make back their money, right? And so they determine what the interest rate is, right? And so that's what this report is talking about. This report is basically showing what is that rate that's going to be set. And this is one of the things that we look at when it comes to like we're looking at the news, and I want to see if I can show you, forgive me guys, some more of this because I think some of it's being cut off. Right? So let me show you this. Okay, now you can see better. So if you look at the top, you'll actually see where it says actual, forecast, and previous. Right? The actual is actually what happened on those dates. What was the actual interest rate on that date? And then you'll see what says forecast. It says this is what they predicted the interest rate was going to be on that date. And then if you look to the right, it says previous. Then you're going to see what was actually the previous interest rate on the last report. So for November 1st, the previous would have been what is actually from September 20th, which you can see is 5.5, 50%. Then you see previous was 5.5%. So what happened here? This is what I want to show you. If you look all the way from November 1st, 2023, all the way to May 3rd, 2023, you'll see the interest rate did not move much, meaning that there was stability in the market. And so when I look at this, I can kind of predict a possibility of what's going to happen in the market. So again, if you notice in this image, the US interest rates didn't move, showing that the economy is stable to lenders. So those lenders that came in and said, okay, we're going to lend money, we're going to lend you what you need while your interest rate is 5.5%. This is great because when you pay back, that's the interest you're going to be giving us back. We're going to make money, right? Showing that the economy is stable to lenders, which would most likely entail that buyers, was the institutions, banks, and even foreign entities, other countries, other country institutions, other country banks, right, can enter into trade, either stabilizing the market or guess what, pushing it up because they're going to get their money back, right? And they're lending the money to us, so that way, now the U, let's say if we're talking about the U.S., they have more dinero to do what they want to do, so the market starts to go up. And this is what we're talking about here. And guess what? When I looked at this, I went back and I back tested this. I went back to the market and I said, oh, I'm going to look at these at these dates from November, etc., to May. And I did a technical analysis. And guess what? The market shot up on an upward trend. You really can't see the date. I accidentally blocked it out. But if you look down this first huge green candle, this was those months from November to May. And guess what? The market was stable. The interest rates were nice and high, right? Stabilizing market, and it shot up. This is what I want to show you, that the banks and institutions move the market. The banks and the institutions move the market. Now imagine if these interest rates were lower. What could happen? The market could have shot down. But that wasn't the case, right? I don't know if you guys got this. I know this was kind of a long video, but what I just gave you was a secret. So when the news comes out, you're gonna learn about this later. You see things like CPI, and you see serious like news in the forex market, and you kind of look at these interest rates, and you look at non farm payroll, which is NFP week. And if you heard about NFP week, that is a time in the market where the market goes crazy. It can make huge moves, erratic, very volatile, very fast, right? I don't suggest you trade in those times if you don't know what you're doing, but you can prepare and you could look for areas where the market will go, and when it goes, it's gonna go like crazy. But if you look at these interest rates, you can get an idea of the direction of where the market's gonna go, or looking at the prediction of the time frame or the time period of the opportunities where the big boys are getting into the market. And this is the reason why I want to show you the reason why I did this video. Understand monetary policy is gonna help you identify when to get in, when the big boys get in. And I'm gonna cover this more over my videos. You know, when we do our analysis, we might look at fundamentals, say, okay, what is monetary policy doing? Where is the potential point, right? We won't always get it. You know, we won't always be perfect, but we can definitely do a decent job where we can say, okay, these are great potentials of where the market is really going to move, or where the whales or the big boys are going to get in. So guys, I know it's a long video, but go back and review this, and leave in the comments your thoughts on this. Leave in the comments your questions if you didn't understand this. I hope that I made this as simple as I can, so you can kind of get this right. And I know a lot of people will probably say, "Oh, that's not what's happening. That's agreeing. You won't agree with me." I know a lot of economists, people who study economy and this and that. They're gonna come in and debate me and all that. That's fine, but um, I, I feel like I've done enough research and I use it as part of my strategy also, to make money and to predict where the market is going. And I believe this is something that's not taught. I don't really see it as much. And I think, from what I do see, it seems like it's a very sensitive topic that they don't like this truth being told. But I'm going to tell it. So I hope this helped you and understand a little better and make it a simplistic when it comes to just reading the news and reading, okay, what is happening in the economy? Big factors, interest rates. And that's what I do. What is happening with the interest rate? What is happening with the interest rate? Right? Looking at the interest rates, right? What is happening with the rates? What's happening with the amount the lenders are charging the borrowers, a percentage being a principal held? Is the rate high? Is the rate low? Right? Who's about to get in the market? What country's about to come in and give their money to that specific currency, that specific economy, that economy? What countries and what institutions are about to come in and say, okay, ooh, you guys got high interest. We see opportunity. We're gonna give you some money. Or what countries and what institutions can come and say, ooh, we're pulling out. And then you normally see what happens. The markets drop. Or what happens when the interest rates plummet? And then companies say, we're pulling out. Institutions say, we're pulling out. And you're ready. You are ready before the market does it. Before MSNBC, before Yahoo Finance or whoever, before they even report it to the media, or before some of the media try to lie to you and be contrarian and tell you the opposite of what's happening. You'll see it for yourself by looking at the fundamental understanding how interest rates work and seeing the technical analysis. You'll say, oh, this market is plummeting. Because you understand who the big boys are. You'll understand, you'll be able to see it and know that, oh, they're about to pull out or they're about to jump in. So ponder on that. And I hope that helped you understand better monetary policy. And I want to thank you again to tune in to Simple Trading. I know there's a lot. I really pray that was simple and it wasn't complex, but I try to make that as a very complex ideology of how monetary policy is set and how the central Bs do that. So it's very difficult to try to break that down to be simple. But I hope that you understand that. But that's the one thing I look for. Interest rates. Who's about to get in the market? Or who's about to pull out? Thank you. I'll see you in the next video. And let's make it great. I want to make you as much money as possible because I know when you make money, you can change the world, change your family, and impact those around you in the greatest form possible. So thank you. I'll see you in the next video. Peace.